Okay, hi everyone. Welcome to Quantitative Investing Festival 2021. My name is Da Wei, one of the festival's panel speakers, and also your host for today. We're excited to have everyone here online with us. It is wonderful for us to be able to come together and learn about a very, very different and alternative form of investing called quantitative investing. Right. We have a full program lined up for everyone this festival. Right. So today we are going to introduce you to the world of hedge funds, which for many of us, we might have heard about them from time to time, but we may have also wondered, hey, why do I not hear so much about hedge funds, right? Compared to many of the usual traditional investments, things like our usual unit trusts, our buy and hold ETFs, our stocks, our bonds, right? Why do we hear so much less about hedge funds? Right? And what are hedge funds actually? Right? What do they do? What do they invest in? And more importantly, is there any way for us to replicate what some hedge funds are doing? And so today we are going to talk about these with my fellow panel of speakers, whom we'll be introducing shortly in a bit. And following which, we are going to talk about a very, very important and even crucial concept of quantitative investing, which is on risk and return. Of course, at the end of the day, we want returns, right? All of us, we want returns. But how do you get those returns more consistently? When it comes to quantitative investing, looking at mathematical risk is extremely important. Right? And don't worry, although I say that it might be a little bit mathematical, but they are still very simple and not complex at all for most of us to understand. Right? So this is what we are going to cover in the second half of this first session today. And before we go any further, let's have an introduction from each of our panel speakers first. First up, we have our team director, Bernard. Bernard, could you introduce yourself to everyone?
Hey, hi, Da Wei. Thanks for getting all these things together. Yeah, so I'm Bernard. I'll be part of the panelist team throughout this whole festival. And let us assure you, we are not recorded avatars who are talking. So we are actually bring this to you live. I do understand that sometimes in some festival sessions, you might just be hearing recordings. So that's not so. And we would love to take questions across from all of you guys. So along the way, type in your questions. And if you want to unmute yourself to talk, let us know. We might even be able to unmute you to get your questions coming in. And of course, for myself, my own focus will be a lot more on the portfolio building. And of course, for me, I've been working with funds, with different foundations, trusts, of course, managing personal wealth for some families as well. So for some of the questions regarding how to fit in portfolios, just direct them across. If you need me to answer any of the issues and questions, I think we are very ready to do that with you. Okay, yeah, thank you, Da Wei. So if we should go on over to our next few speakers.
Thanks, Bernard. Next, we have our partners from AllQuant, Patrick and Ingwan. Next slide is on Ingwan. So Ingwan, maybe you can introduce yourself.
Okay, thank you, Da Wei. Can you hear me, right?
Yeah.
Okay, a very good day to everyone. First of all, thank you for taking a precious time off to attend this webinar. So my name is Ingwan. I'm one of the co-founders and partner in AllQuant. So what we do at AllQuant is to specialize in educating retail investors in the area of quantitative investing. And aside from that, we also work actively with the industry to promote quantitative investing to the general public, and in the hope that we will empower the everyday investors with more knowledge and choices. Now, before setting up AllQuant, I spent about 15 years across the asset management and banking industry. So I first started off in GIC asset management. That is where I analyze and conduct investment due diligence on hedge funds, and for the purpose of allocating money to them. Then after that, I moved on to investment banks, namely like Credit Suisse and Barclays. And over there, I did something different. So I was responsible for valuation control matters on equity, exotic rates, and structured products that the banks trade with their institutional clients. Okay. And after the stint in banks, I spent my next couple of years in proprietary trading before eventually joining a local hedge fund called Liquid Value Asset Management as a portfolio manager. And over at the hedge fund, I co-manage a multi-strategy fund together with my business partner, Patrick, whom you're going to meet shortly. Okay, so that's in a nutshell is my background. I hope I can give you a lot more value later on in my presentation. Okay, so at this point, I'm going to pass back to Dawei for the next person to present. Okay, Dawei, back to you.
Thanks, everyone. We still have Patrick. Patrick, maybe you can introduce yourself to everyone as well.
Yeah, sure. Thanks, Awe. Yeah, everyone. Hi, my name is Patrick. So I'm a co-founder of AllQuant. So before starting AllQuant, I've spent also about 15 years in the industry. I first started out as a portfolio manager in UBS Private Bank, where I helped to implement discretionary portfolio mandates for private clients. So after a couple of years there, an opportunity came up to move to Hong Kong to work for an investment bank, covering hedge funds and institutional clients who wanted to trade equity derivative products like options and swaps. So eventually I came back to Singapore to join Credit Suisse Product Control Department. My job there was to review rates and FX structured products traded by the bank. Ultimately, I ended up running money in prop trading and eventually a local hedge fund together with Ingguan. Okay, so that was just a quick intro to my professional background. I'll probably speak to you guys more in the next few weeks. So for now, back to Dawei.
Thanks, Patrick. And lastly, just to introduce myself a little bit more. So for those of us who didn't catch my name just now, I'm Dawei. I'm an investment advisor at iFAST Global Markets. And I'm now approaching around my 4th year of full-time investment advisory work after coming out of NUS, where I majored in financial statistics, which are very much related to quant models and quant investing. Right. So throughout the years, I've had the privilege to serve a variety of clients, both young and old, financially humble, and also those blessed with great wealth. And therefore, it is truly a pleasure to be here today and help guide everyone in navigating the world of investments. So without further ado, let's go straight into the topic at hand today. Why are we here today with our panel of speakers to talk about quant investing and hedge funds? I think this very much happens to be in line with Patrick and Ingguan's past work in running hedge funds, and eventually also transiting out to set up their own investment education firm, AllQuant. Can we invite my fellow Zoom panelists here once again to share on your views and experiences in the investment industry, especially on how hedge funds and quant investing function as a whole? Maybe we can have either Patrick or Ingguan to start first.
Okay, thank you, Dawei. Maybe I'll go first. So now, if you think about it, quant investing is actually not something that's new. But if you were to ask like any man on the street right now, chances are he's going to give you like a blind look. Okay, so but the use of like science, math, statistics have actually been extensively adopted right within the hedge fund industry for many years. So in fact, it existed right well before I joined the fund industry back in 2006. But back then, they were still a very small and niche group. Okay, but today as a whole, they have grown and progressed a lot. And while they're still the minority, quants have now grown to represent a sizable portion of the industry, and they have definitely punched above their weights. So to the extent that we have today, right, the largest 3 hedge funds in the world, they are all quant funds. And the world best hedge fund in the world, right, is also a quant fund. Okay, now there is no way they can kind of like get to this stage by chance, because hedge fund is one of the most competitive industries. So to get to where they are today, the only way for them to do is to actually demonstrate that they have a sustainable edge, right, in their performance. Okay, so unlike what a lot of people think, hedge funds are actually not as risky as painted by the media, right? In fact, they have been delivering over time good returns using a much lower risk, right, than average funds out there. Okay, but the unfortunate thing is that hedge funds are off bounds to the average man by regulations, okay, because they can only target like high net worth and institutions. Okay, so in a way, retail investors have actually been missing out on a very big chunk of good options out there. And that is one of the primary reasons why Patrick and I set up AllQuant. So the aim here, right, is to address or target this particular gap. So yes, these hedge funds may still remain inaccessible to most people, but today, with like better technology, more product innovations like ETFs, easier access to like different various markets and asset classes, as well as lower transaction costs, some of these quantitative strategies that are being used by hedge funds are no longer beyond, let's say, the man on the street. Okay, they can also be adapted for retail use if you know how to do it. Okay, or alternatively, you can engage the help of like a professional, like an advisor to help you implement it. So that's what we at AllQuant do. We teach people how they can invest using quantitative techniques and also work with the industry to provide people with more options to invest, right, using such quantitative approaches. Okay, so anyone want to chip in and add on, right? Okay.
Yeah, maybe I'll just like to add on my own experience. So I didn't start off as a hedge fund manager or professional. In fact, I started off as a retail investor. So my introduction to hedge fund and this professional world of investing is a gradual process. So as I mentioned earlier, right, my first job was actually with UBS as a portfolio manager. So over there, one of the interesting mandate that I implemented for clients, right, was what is known as an absolute return mandate. So maybe let me explain a little bit about what absolute return is. So it is actually just an investment philosophy that strives for positive return independent of any market benchmarks. So in contrast, right, most traditional funds out there, they seek relative returns, which means they strive to outperform their selected market benchmark, which is usually a stock market benchmark. So when the stock market is up, they want to be up more. And then when the stock market is down, they want to lose less. So I guess in the end, I found myself identifying more with the absolute return philosophy. So that's where I started to find myself moving more over to the hedge fund space. So then when I move on to my next role in the investment bank, right, in Hong Kong. So at that time, it was quite interesting to be in that role because it actually coincided with the great financial crisis in 2008. So during that period, right, while the market crashed and everybody around the world, I mean, most professionals, they are witnessing losses in their portfolios, right? I saw firsthand how a hedge fund client of mine actually made billions for his clients from trading volatility during this period. So that experience not only introduced volatility as an asset class to me, but it also planted the seed for me to develop my own volatility trading strategy a few years later. Okay, then coming back to Singapore, when I was with Credit Suisse, right, I was exposed to a different asset class from equities. And this time around is basically interest rates. So interest rates is also a very interesting asset class because, I mean, a lot of people think of interest rates as just a product that gives them some sort of coupons, right, regular coupons. But actually, there's very interesting characteristics in this asset class that actually provides a very good diversification benefits to an investment portfolio. So from there, it became a core part of my own investment process. So that's how I basically transited into a multi-asset and multi-strategy kind of person that I am today. So yeah, so that in the nutshell is basically what I have to share on this topic. Yeah, back to you, Dawi.
Thanks, Patrick and Ingwan. Bernard, do you have anything you want to share?
Yeah, yes. So I think it was wonderful that Patrick mentioned something just now, that there can be alternative or different strategies available for investments. So in my actual area of work, I interact a lot with clients. Some of the clients are probably like many of us over here as individual investors. But over the years, I start to work with foundational funds or institutional funds, groups like, so to name a few, I work with a few religious groups around to manage their endowment funds. There are some schools around that has endowment funds that I work with as well. I did realize that many of the groups are very limited in their investment strategy, especially with some of the more religious implicated funds. They may just be putting their money into maybe fixed deposits. Is it because their fixed deposit is not good? No, it is not. But with a changing interest rate environment, right now they're facing huge issues. They have their returns that comes back from fixed deposit are probably only in the range of 0.4 to 0.5%. So they're facing such issue. And that's where I started talking to them about different alternative strategy. Or maybe I will share, instead of strategy, different styles of investments. And so now that we understand that there are different instruments available, there are different styles available. So with the same instrument, money market, which is fixed deposits, there can be different styles of doing it. So we can still be on the same exposure, but different stylistic way of running things. And I guess quantitative investing is actually a style that a lot of time many people are not aware of, don't know how to use it as well. And maybe we are asking questions that is an alternative investment strategy. Does it mean that I cannot do it because I'm not an accredited investor? So I guess actually I think over the next two weeks plus, we want to share some possibilities of how to change your style, maybe not to change altogether, but maybe to adapt different styles of investments such that you can be getting levels of returns using different methodologies. Okay, so yeah, so that's my way of looking at it. Have different styles available so that when the market changes or when your life situation changes, you will have different styles of investments available. Yeah, instead of staying only onto one single style to long, merely just to long, or even just I think many will be talking about value investing. Value investing is a wonderful style. I adapt that as well, but we should have more than one styles. So that's where I will look at things. Thanks, Dawei.
Thanks, Bernard. Maybe just let me add on as well. Why are we talking about different styles, right? Why are we talking about quantitative investing as an alternative form of investing or different form of investing? Okay, so maybe let me just bring this up here, okay, for the good of everyone's understanding. Okay, so if you look at this figure over here, which actually comes directly from some examination chapters even for advisors in the industry. Okay, so we can see clearly that QA or quantitative analysis is a different set of analysis methods that is apart from the usual fundamental and technical analysis that we often hear about in the industry, right? Which also means that all the professional investment approaches in the world, right, they would follow at least one of these three investment methods, or at the very least, be dominant in one of these three. So for example, like today, if someone is sharing with you to buy, say, for example, US market, right, because say US has a young and healthy population, right, they are led strongly by the US big tech, like Apple, Facebook, Microsoft, Amazon, right, which have been constantly innovating very well over the years, right, and therefore maybe they say that they expect an annual growth rate, right, of about say 15 to 25% per annum. Okay, so when we hear these kind of things, right, these are fundamental analysis. Right, we look at financial statements, economies, industries, countries, how they are doing, what are they doing, and most importantly, what will they be doing going forward. And on the other hand, if you hear of an investment expert online sharing with you how he draws graphs, right, how he draws support and resistance lines, but usually having stop loss mechanisms and even time-sensitive trades, right? More often than not, these are technical analysis. Okay, so the last and final means of investment analysis, right, quant analysis. This is something that we can say we really need to see more of in the retail sector, right, especially in the professional field where we're guiding all of you. And most of the time, this is where fundamental investing dominates, right? So professional investment approaches that focus more and center more on quant analysis, they are often more found in hedge funds, like how Ingwan mentioned just now. So therefore, we may have this question in our minds, right? Actually, how reliable are hedge funds? Are their strategies what we would want to replicate? Can we actually replicate them? So for these questions, actually AllQuant has already started to answer them when they reached out to our next generation of young investors. So we want to educate and bring greater awareness to this alternative way of investing. And we've already begun to do so prior to the festival. A while back, AllQuant, you guys, we held a session. You guys held a session with the students from NTU and SUSS, our universities in Singapore. For those of us who may not be from Singapore, right, these are students from our local universities. They are currently members of our investment student clubs and CCAs, right? So the session was especially there from AllQuant to introduce and guide the students on what hedge funds are and what quant investing is. Right? And Ingrid and Patrick, maybe you guys can share with the audience what you went through that day when the Zoom session was held with the students.
Okay, Tawi, thank you. Okay, basically what I did was I gave the students an overview of the hedge fund industry. There are different types of strategies, and most importantly, like how they're different from, let's say, traditional assets or funds out there. I think the best way to actually see it, even without knowing what hedge funds really do, right, is to look at the performance profile. So this chart you see here is what I showed the students. Okay, it shows the net asset value of an aggregate basket of hedge funds and compare them, right, against the world stock market and the Singapore stock market. Okay, since like 1990. And to compile all this data, I make use of the Hedge Fund Research Index, or the Fund Weighted Index, to represent hedge funds. The MSCI World Index represent the global stock market, and the MSCI Singapore to represent the Singapore stock market. So dividends and withholding taxes are all included in the performances, and everything is measured in terms of USD for a more objective assessment. Okay, so if you have like $1,000 in hedge funds, right, all the way at the start of 1990, then today it is going to grow to $17,000. And that compares favorably against, let's say, $7,000 for the global stock market and $6,000 for the Singapore stock market. So overall, right, hedge funds in aggregate actually delivered a better performance, right, over this period. But the notable thing is that it did that, right, using a significant lower risk, right, which is what really sets it apart from traditional funds out there. I mean, it wouldn't be a big deal if, let's say, you take higher risk and you end up with higher returns, right? Because that should rightfully be the case. But right here, we're actually talking about delivering more using lower risk. Okay, that way you might want to switch over to the next slide. Okay, thank you. Now, and if we were to extract out the key crisis period during these 3 decades, you will know the difference even more. Okay, during the Iraq invasion of Kuwait in the 90s, where US is pulled in, right, the stock market actually crumbled, but hedge funds, right, during this period actually still made some money. Okay, and during the dot-com episode in the 2000s, right, the stock market plunged like 40% at its worst point. But during the very same period, hedge funds lost just only 2%. Then if we fast forward to like the great financial crisis in 08-09, as well as the more recent COVID-19 triggered sell-off, right, back in 2020, hedge funds also lost significantly less than what the stock market does. Okay, and how are they able to do that, right? So hedge funds are able to do that only because they're running different types of strategies across various different asset classes and markets. And as a result, their returns, or the returns that you see here, they are not very correlated with the broader stock market in general. Okay, so contrary to what many people may think, hedge funds actually focus a lot on risk and risk management, and they're not as risky as what is painted out to be people out there. Okay, so this in general kind of sums up briefly the points that I made during the student sessions. Okay, back to you, Tawi.
Thanks, Nguyen. So all in all, today's key message to everyone through our discussion on fund investing and hedge funds is this: where hedge fund strategies are suitable for us. Although hedge funds themselves, they might be out of reach for retail investors, it is very possible now for us to replicate their investment approaches. And this is particularly due to the rise of fintech and the ETF asset classes. If you look at how things are many years ago, we had a much lower number of platforms for us available to run DIY investments, right, through our mobile phones, our laptops, right? We see so much more of them today, right? And today we also have a much wider ETF asset class available to many of us to run our own investments. And very importantly, we also have some very distinct ETF assets, right? Some ETFs we have seen include volatility ETFs, right? These are very special things that are now available for us to run some quantitative investing strategies that hedge funds do. Okay, so if you're looking to diversify your investment strategies, today you can definitely consider running quant investing to do so. Okay, and in relation to diversifying among strategies or searching for alternative strategies is our students' challenge for this quant investing festival. Right, so if you were wondering why AllQuant held a session for students from NTU and SUSS, right, it's because they've been preparing them for this students' challenge, where they'll be showcasing their hard work and preparation on the final 2 Saturdays of this festival, on the 25th of September and the 2nd of October. So for those of you who are students from SUS and NTU, I've seen your signups. I'm very happy to see you guys supporting your friends from the investment clubs. Right. Can't wait to see all of you on the 25th and the 2nd. And also for the benefit for the rest of the audience majority, let me just mention what this challenge is about. Right? So in this challenge, we've given the students an example situation that might be similar to many of us. Right? Here we have a hypothetical Mr. Lim, right, who is age 38 this year and is a father of 2 children, right, who evidently, alongside increasing responsibilities in his working career, he also has to spend more time taking care of his family as he gets older. So over the years, our Mr. Lim has run investment strategies based on fundamental and technical analysis, and he's now looking for a third investment strategy. So our challenge to the students is to help Mr. Lim construct a portfolio based on quantitative investing and using exchange-traded funds. Right? If you're keen to hear what our next generation of young investors are thinking and learning, make sure you do join us on the 25th and the 2nd. Okay. And so before I pass the time over to Ingwan to talk about risk and return, I'd just like to mention here that at the end of every festival session, we are going to have a very short quiz of 2 questions for everyone to just kind of recap and on what you have learned. Right? And also for you to have a chance at our lucky draw. Right? So every correct question that you answer, right? Every correct answer that you have for each of our questions, right, across the multiple quizzes over the course of our festival, right, is going to give you an added chance, right, to win that lucky draw. Okay, so if you have more than 1 correct answer, you're going to have a higher chance. This festival, we are giving away CapitaLand vouchers, right, on top of AllQuant's mega, intermediate, and starter course packages, where you get to see in your own free time very useful strategies on how to run your own quant investing. Right? In fact, AllQuant's own students have, through the strategies that they have learned, run their own quant investing strategies in markets across Europe, US, and Asia. Right? I know this because I've had the chance to speak with some of them, and wow, they are really very strong in running these quant investing strategies. So although not every one of us might be very good at running DIY investments, right? In fact, a lot of us might feel that, hey, actually I would prefer to be a little bit more passive, right, and not be so active on running investments on my own. But no worries, because in time, when you do want to come and explore on running quantitative investing strategies, right, these are still going to be very useful and helpful to you. Right? So as long as you're an investor, right, these are going to be very valuable to you. Right? So please continue to pay attention as I pass the time now to Ingwan. Ingwan, are you ready to begin?
Okay, you can see my slide, right?
Yes.
Okay, that's cool. Okay, today's topic is going to be on how professionals see risk and return. All right, now I've been asked this question before, like, what is the difference between how professionals approach investing versus like how a typical person does it? Okay, now there are many differences, but I think the most important one that probably sets like these two groups of investors apart is really their focus when they zoom in and look at investments. Now, retail is going to look almost, if not entirely, just on returns, right? For example, right, what can I make from this investment? Is this investment going to make me more, or is that one going to make me more? And I think it's a fair and sensible question because after all, our goal to invest is to make money, right? But that often make people miss out on a lot of other important things in their investments, okay? To the extent they may actually have no idea of what they're really getting themselves into. Okay, professionals, on the other hand, besides just looking at returns, they also focus a lot on risk. For example, they're going to ask questions like, what are the risks involved behind getting those returns? But because they know ultimately it is the risk taken that is driving those returns. Oh, and I like getting a fair value for the risk taken? Am I adequately compensated? Or am I taking excessive risk? Or are there hidden tail risks that I'm not really like, that is not really apparent? And if we know all these risks, then can we mitigate and further reduce those risks? So these are some of the questions that professionals will always ask as part of the internal process before they actually put the money in. Okay, so now what exactly is risk? Okay, and why is it so important? Now, if I were to ask you this question now, what do you think risk is? I think most of you is going to define risk simply as how much I can lose, right? I mean, that is, of course, the most direct thing that the majority of us can relate to. Okay, but there are actually more to risk. Okay, how about the uncertainty of your investment outcome, for example? Let's say if you invest today, do you know, or do you have a sense, right, of how much you're going to end up with like 20 years later from now? Okay, you're going to have a target, and will you hit your target or will you miss? And if you do miss, then what is the expected shortfall from your target? And in a really bad scenario, what if I make less than half of what I need? Okay, then that's going to be a serious situation, right? So this is a very real risk that is also very often overlooked or understated by most people. Okay, then there are other risks. So what about risks, let's say, associated with market timing? Like people often ask this question, when is it the best time to invest? Should I be putting all my money to work at once, or should I say dollar cost average? Should I try to like predict the markets and start trading in and out, right? So a lot of people cannot resist the urge to really time the market because the stock market moves up and down, right, in such a big range. Okay, but I can tell you this, there are really large scale studies that were done, right, to prove that the majority of retail investors who trade in and out short term loses money eventually in the long run. And if you want to know the number, is this, okay, 90% of the retail investors or traders who does this loses money over a 4-year period. And after that, they went to close their accounts. Okay, so this is also a risk. Okay, that there is also risk of irrational actions that can be taken, right, due to your own emotions at play. Now, emotions is especially pronounced when it comes to investing, right? Because many people often invest or trade without a plan, okay? Or they may have a plan, right? But it's not very well thought of, right? And so when it comes to the crunch, they're not confident that it's going to work. Or even if they have a workable plan, they may not have the discipline to really stick to it. So emotions become primarily what drives retail investing. No greed, your fear of missing out, the fear and pain of losses. So that's how people end up like buying high, selling low, and then making losses in the long run. So all these are risks, okay? And knowing about them is a good start, but it is not good enough. We still need a way to kind of quantify or measure them so that we can put them into use. Okay, and what I'm going to do over the next few slides, right, is to introduce to you like 2 very common and widely used risk measures. Okay, so the first measure is called volatility. Okay, volatility measures the tendency and extent to which the price of a financial security kind of like fluctuates up and down over a period. So in math or statistics, right, the term we use is called standard deviation. Okay, it is a very basic concept. So we can measure volatility on a lot of things, like on a stock, a bond, an ETF, or a mutual fund, etc., etc. Okay, now to get an intuition, right, behind what volatility is, imagine you now got a fund called A. So what this fund A actually goes up just at a constant rate of return, right? No fluctuations. So this fund based on volatility, right, is going to have 0 volatility or no risk. Okay, then now we have fund B. So fund B moves up and down in a moderate way. So this fund has medium level of volatility or medium risk. Then finally, we have fund C, okay, which moves up and down in huge swings. So this fund would be perceived as something that is highly volatile or highly risky. Okay, now the larger question now here is, right, is what is the big deal about all these fluctuations and the prices? I mean, prices of securities moves up and down all the time. So how does that translate to risk? I mean, does it even matter, right? And the answer is yes, right? Because volatility is closely associated with uncertainty in your investment outcome. Okay, it may not be apparent over short periods, like if you observe it over days, weeks, or months, but over the long term, the impact can be huge. Okay, to get a sense of what I meant by that, just look at this slide. Okay, what you have here is a blue path that goes up at a constant rate to hit $1 million, which let's say assume is your target. And this is the ideal path that you want to take, right? Just straight up, no fluctuations, no nightmare. Okay, so then along the way out here, you have many other orange paths. And what are these orange paths? They're all possible paths that are generated using a high volatility. So as you can see from here, right, the range is huge. Of course, on the positive side, you can have scenarios where at the end of the day, you exceed your target, right? I think that would be good news, and I'm sure no one's going to mind it. But similarly, right, there's also the good chance you can fall right below your target and miss it by the big amount. Okay, so this huge variation in the possible outcomes is what we meant by uncertainty. Okay, so I believe most of you are familiar with investing in stocks, right? So let me try to reinforce again this concept with a scenario using actual global stock price data. So what this chart shows you here is the outcome of a 20-year investment plan. So in this scenario, what you do is you invested $120,000 into global stocks at the start of the year, right? Indicated by the horizontal axis over here. Okay, and your target is to grow this portfolio to a value of $660,000, or which is roughly works out to be about 8.9% per year. And why do I pick this target? Because that is approximately the average yearly performance of the global stock markets between 1970 and 2020. So over this 50-year period. Okay, then the value which is plotted on this blue line over here shows you what you're going to have after 20 years. So as an example, let's say if I invested at the start of 1970, then what I will end up with, right, after 20 years in 1989 is going to be this point here, which is slightly over $1 million. But if I were to start in the year 1999, which is down here, then after 20 years at the end of 2018, right, what I would have is only about $231,000. So, okay, I believe you get the idea of what this plot is trying to show you here. Okay, the good news is that with this, you didn't lose any of your investor capital in all the scenarios. Okay, but the variation in what you get at the end is enormous. Okay, depending on the year which you start. So it can range, as you can see, anywhere from like $231,000 to as much as like $1.5 million. Okay, and your chance or probability of missing your target of $660,000 is not trivial. Okay, as much as 50% of the outcomes here actually misses the target. And the average shortfall we're talking about is minus 45%, with as high as going all the way up to minus 65%. So a shortfall of 65% means that you only hit like 1/3 of your target. Okay, and when that happens, what can you possibly do? Are you going to hold your investments for another 20 years? Okay, so a high level of certainty, right, is capable of seriously derailing your plans. Okay, so this high vol, right? Then what about low vol? So very straightforward, it's just the reverse. It just simply means you have less uncertainty. So this is the same chart as the one that I showed earlier, but the possible paths now are replaced by all these green paths, which are generated using low volatility. And the difference where you can see from here is pretty clear. Okay, with lower volatility, you don't kind of experience the huge swings that you can expect, right? And the outcomes are also going to be clustered a lot closer to your target. So yes, you don't have as high as upside as what you saw earlier, but you're also a lot less likely to miss your target big time. So that's what professionals concentrate on the risk. They spend a lot of their time and focus on managing risks and downsides so that we can actually greatly achieve our chance of like hitting the target. Okay, so that is also why vol is actually commonly referred to as a gauge on uncertainty. And don't underestimate its importance. A lower volatility is actually a highly desirable feature out there. So it lowers your overall shortfall risk of not meeting your target. And besides that, there are also other benefits, right? With lower volatility, you're less likely to kind of give in to your own emotions and meddle with your investments, because now the value of your investments are a lot more stable. It also reduces your temptation to time the market. Right, because if you look at it, you don't get as much advantage trying to time, even if you get it right now, because a low vol and stable investment don't fluctuate as much. So they're not like your stocks now where they can potentially like good rewards if, and a very big if you manage to pick near the tops and bottoms. Okay, so lowering volatility and risk, right, of your investment can help immensely with your personal emotions, your trading psychology, as well as your discipline. Now, the next risk measure that I'm going to introduce you is known as the maximum historical loss, or what is also commonly referred to as the maximum drawdown. So it is a very simple and intuitive measure because, as the name suggests, it just simply measures the most that you can lose based on historical performance. Okay, and that is the largest like peak to trough dropped from the financial securities entire history. Okay, so in this picture, the largest peak to trough is minus 55%. So that is the maximum historical loss. So of course, while history is not a guarantee of what can happen in the future, it is still nevertheless a very good reference for what you can possibly lose, right, in a really bad situation. Okay. Now, and unsurprisingly, volatility and maximum historical loss are actually related. So the higher the volatility of security, the larger tends to be the drawdown or its maximum loss. And you can see from this chart. So this chart here shows you a scatter plot of the maximum historical loss, right, against the volatility of the individual stocks within the S&P 500. So every single point or dot right down here represents a component stock within the S&P 500 index. And if you try to fit a straight line through all this point, you can see a pretty strong relation. So as an estimate, right, based on the data here, for every 1% increase in volatility or risk, well, the maximum loss gets larger by about 1.5%. Okay. So at this point, you should now be able to better appreciate like why risk is important and how it can be measured. So a professional investor actually focuses a lot of the resource to actually find ways to use the least amount of risk to get the job done. And if you yourself, you also understand risk, how to measure it, and how to make use of them, you can also significantly improve your own investment process, right? Because with information about risk, you know potentially like how much you can lose, right? And if you know how to do it, right, you can make use of risk to help size up your positions, okay? And you have an idea of, say, how far off you can potentially end from your target outcome. And with now a fuller picture of both the risk and returns, you can assess that the risk reward, right, is whether it's attractive enough. And is it good enough for, let's say, for me to take on more leverage, right, to support or boost my investments. And if I were to take on leverage, then what is the optimal leverage I should be taking on? Okay. Right. And finally, it helps you stay rational in the market because you can now run your investments safer at a lower risk. All right. All right, now I've talked about risk so far, right? I introduced like two key risk measures that are commonly used, and I've touched on its importance. So now I think there's also need to kind of address a lot of like, or some of the more common myths against risk out there. And I believe many of you is going to come across all this as well. Okay, higher risk are the first one. Okay, higher risk, higher return. All right, and lower risk, low return, or no risk, no return. Now, if you think about it, this is a statement you will have to agree because it's just plain common sense, right? And this statement I can tell you is true. Okay, but the thing is you got to be taken in the right context, right? Because not all risks are the same. Market compensates you only for taking on non-diversifiable risk. Now, it does not compensate you for risks that can be diversified. And what are risks that can be diversified? These are risks like your stock-specific risk. Now, the issue here with this statement is that it's often used very loosely by people to the extent that they are kind of overly abused. I mean, you'll hear people who often justify, like say, like why they buy one or two highly risky securities or take very concentrated positions while using this argument of high risk, high return. No, but however, in such a context, this is actually not true. Okay. So if you look solely at individual securities, higher risk actually does not translate to higher returns. In fact, it is the reverse. Okay, so this is a scatter plot, right, on the annual returns of the 500 stocks inside the S&P 500 index plotted against their volatility of risk. So there may be a few outliers here that do indeed exhibit high returns of higher risk. Okay, over down here, but those are far and few between. Right, for the bulk of the stocks that are here, right, that is not the case. And if you try to fit a straight line through all these data points, what you see is in fact that higher volatility tends to be associated with lower annual returns, right? And not higher annual returns. Okay, so that is the first myth or the first commonly misunderstood statement that people often make. Now, another common argument on why risks don't really matter is this. Okay, as long as you have the right skills to pick the right stocks, then risk is not an issue, right? Again, this is not necessarily true because there's a very big if, and the big if is if you have the right skills to pick the right stocks. Okay. So you may have seen, read, hear from internet of someone that stock picking is easy. For example, you might be shown or given charts like this, and then they start to trigger you to think about, now, do you know that how much you could have made if you invested with any of these stocks at the inception or when they IPO? I mean, if you look at it, wow, right? I mean, Apple 72,000% and Amazon 120,000%. So all these are astronomical returns that can easily tug at your heart, right? Because if you think about it, I mean, all I need is just a one right stock. But again, if you seriously think sensibly and give it more thought, but you realize that all these stocks are almost right entirely on what we call hindsight. I mean, yes, for sure, someone somewhere down the road would have gotten big about those stocks, but I have no doubt there aren't that many people, okay? And for those that have, some of the key questions remain. Like, for example, do they have a systematic methodology that can be put to the test when they pick up those stocks? Because we want to know whether what they do is repeatable, right? And how high, right, is the rate of success from a statistical point of view? And how much of those actually boils down to what we call luck? All right, in reality, getting the kind of return is far from easy, because what is possible does not mean what is probable, okay? And picking the stock is only just the beginning. If you look at it, there is a whole range of decisions across your entire investment process that matters. For example, first of all, are you invested in the stock? If you're not, then there's nothing to talk about, right? Then two, if you are, then when did you invest? Because if you invest late, then you're going to miss out on probably the biggest chunk of the gains out there. And three, how much money did you invest in it? But because if all you put is really a small, tiny amount, then even though the gains are substantial percentage-wise, in absolute dollar terms, it may not be that significant, right? And if you indeed invested in early in such a stock, would you still be holding on to it after it went up so much? Okay, I don't know about you, but many people I know personally would have taken profit well before it even doubles or triples. Okay, much less waiting for it to reach where it is today, right? And at the end of the day, how much wealth you make, right, is also not just about that one single stock, right? Yes, you got a big winner, but how about the rest of your portfolios? Well, how did they perform? At the end of the day, it is your entire portfolio that matters and not just that one single position. And to pick such stocks early in the game, then you're probably looking at investing in a company in the early stages where the risks and stakes are going to be high. Now, if you pick a stock randomly, but the probability of you actually landing on one that goes bankrupt, right, is actually higher. In fact, a lot higher than one that goes on to become the next Amazon, right? So this is data picked from the government websites. So every year, more than 20,000 business files for bankruptcy in the US. Okay, and these numbers, of course, they're not all public listed companies, but they include publicly listed companies. So as a rough gauge, right, in crisis periods such as the dot-com and the Great Financial Crisis, you can have as much as between 300 to 500 publicly listed companies going bankrupt, right? Do you have 300 to 500 companies going on to become the next Apple or next Amazon? No, right? Okay, now the point of stating all these things is not to discourage anyone from picking or investing in good stocks. So there are good and sound stock picking strategies as well, right? But the key thing is you cannot disregard the risk. And please don't harbor like unrealistic expectations, because at the end of the day, well, the price can be more heavy than you think it is. Okay, the third and the last beef I want to talk about is this. Okay, you will always win, when you buy and hold an index fund, say for the long term. So this is another very common argument. Okay, but I have kind of touched on this earlier. Risk is not just about losing money, right? It can also be about like not meeting your target. And I've shown you how the outcome earlier of a 20-year investment in global stocks can vary, right? Depending on the year which you start. So what I'm going to do next is just simply present or show to you some of the performances of the various different stock markets to set your thinking. All right, so this is the US Great Depression that started in 1929. Also, this is the worst that the US stock market have experienced to date. Okay, so from peak to bottom, the stock market actually lose close to 90% of its value. So this is way more than the Great Financial Crisis. Okay, and the entire period at the end took 25 years before it recovers. So this is one really steep drop and long recovery process. Okay, but if the US Great Depression is a little bit far off to register any impact, then you look at this one. So this is Japan's Nikkei 225. So in 1989, Well, the Japan stock market entered a prolonged downturn, which is known as the lost decade, where it just keeps going down and down. And actually, it lasted more than a decade. It bottomed out only in 2009, 20 years later, and after losing like 80% of its value. And even to today, right, after more than 30 years, Nikkei is still nowhere near where it once was, right, in 1989. And this last one I want to show you is Singapore. So this is the Straits Times Index. So during the great financial crisis in 08 and 09, the STI crashed like 60%. And 12 years later, we are still in the process of recovering. So when will it recover? We don't know, right? And when another crash, let's say, come along to start derail everything before we can even recover, we don't know as well, right? But if another big crash comes along, the question is, do we still have another 20 to 30 years to spare, right? So right, the point I want to drive at, right, is really not just to take a lot of all these common statements out there at face value without kind of doing a little bit of studying or your own research, right? Because they are not always what it seems to be. Okay, even though it might sound like common sense at times, because really the risk is real and the risks are there whether you want it or not. All right, now the good news is this, we're actually not defenseless against risk. So while we cannot, let's say, entirely eliminate risk, we can actually manage them and lower them dramatically. So hedge funds and investing professionals out there have been doing this all the time. And what I'm going to do next is I'm going to share or briefly touch conceptually, right, on some of the ways hedge funds go about doing it. Okay, and actually your first line of defense and also the best line of defense is actually what most of you are already familiar with, and that is your good old diversification. Now, don't belittle the power of diversification, because when you do it right, it can actually dramatically reduce the risk of your portfolio, yet at the same time, without necessarily compromising on your returns or your target returns. Okay. Now, there are actually different levels of diversification. Now, most people are familiar with what is called the basic level, which is diversification across securities within the same asset class. So, for example, you may invest in stocks across like different sectors and countries. So this gives you some protection, in particular, let's say, against a stock, sector, or country-specific event or crisis. But overall, it is still limited against an event of a global magnitude, like let's say a global stock crisis. All right. So the next second level of diversification, right, is across asset classes. Now, most of you are familiar with stocks, right? But the financial market is actually much more than just stocks. So for example, the bond markets are huge, right? And even larger than the stock market, okay? And there are also other major asset classes like commodities, real estate, and currencies, as well as the alternative asset classes like volatility. So each asset class, right, they all have their own distinctive characteristics and behavior. So one asset class can perform differently from another, let's say under different market regimes. So for example, when you have a stock crisis, stocks is going to crash, right? But government bonds, on the other hand, will do very well, right? Because bonds are perceived or regarded as safe havens. So during a crisis, right, money is going to flow from the risky assets like stocks, and then they're going to float inside to all the safe haven assets like bonds. So diversification across asset classes can provide you an even higher level of benefits. And finally, at the third level, at the top level, we can also diversify across different strategies. So an investment strategy is like a specific way you make money from the market. Okay, and they can vary, right? And they can be very different from one another. So let's say you have an asset allocation or a sector rotation strategy. Now, it can perform very different from, let's say, the volatility trading strategy. So for example, a sector rotation strategy may be undergoing a tough patch, right, at the start of a stock market crisis when it's still trying to adapt to the market. But meanwhile, the vol strategy may be having one of its best periods because it may already be positioned, well, to capitalize on the surge in volatility that's going to come up next. So in a way, this level of diversification is like you hire different traders who have different skill sets and uses different methods to make money from the market for you, right? And this opens up a lot more choices. So with a good blend of strategies that are uncorrelated with each other and applied across like different assets, different markets, different securities, you can actually build a very robust and stable portfolio. What that gives you low risk as well as good returns. Okay, and Aside from broad level or high level diversification, hedge funds also apply risk management techniques, right, at the strategy level. So we can look at things like position sizing, like how much do we size to each strategy? How much do we size to each asset class? How much do we size to each security? And should we be using leverage? And if you're using leverage, what is the optimal level to use? And besides position sizing, right, how much to buy or sell, then each strategy can also have its own entry or exit rules. So an asset allocation strategy, for example, may kind of size up bonds and size down stocks when the risk of stocks surge during a bear market. A trend following strategy will ride on a trend, right, for as long as possible, right, until it establishes that the trend has been broken. So if let's say the trend flips down, right, then the trend following strategy may start to size down, cut the position entirely, or even turn short, for example. Okay, and some strategies may also impose stop loss if it makes sense. Okay, and stop loss, and what we mean by stop loss is we size down or cut positions entirely if let's say the losses exceed a specified target. All right. And we can also introduce what we call elements of hedge within the portfolio. Now, hedging is very common in hedge funds because they do that to reduce risk and protect downside. For example, we can pair a stock-specific strategy with, let's say, dynamic allocations to treasury bonds. And that kind of help to dampen the effects of a crisis, right? And make the portfolio more resilient to, say, major stock market shocks. Okay, so how would the performance of a diversified multi-strategy portfolio look like? So this is a chart and table that kind of summarizes the performance of the multi-strategy portfolio we modeled. So we only use ETFs here, right? And it runs 4 different strategies in parallel. We have an asset allocation strategy, a sector rotation strategy, a country strategy, and a volatility trading strategy. So overall, as you can see from here, it is capable of delivering a strong performance, yet with lower risk at the same time. Okay, and if you look at the numbers, right, it actually clocks a higher annual return of 11.4% against the global stock market and the Singapore stock market. Okay, and just for info, we're using the data from MSCI indices to compute these numbers. So dividends are reinvested and everything is, again, measured in USD. Okay, and risk-wise, right, the multi-strategy portfolio actually uses much lower risk as well, right? 8.8% against 15.5% for the global stock market and almost 22%, right, for the Singapore stock market. And the largest historical loss experienced by the multi-strategy portfolio is also much lower, right, than those of the stock markets. So at its worst point, right, it lost about 12%, and that compares against like between 50, right, to 60% for the stock markets itself. Okay, and throughout this entire period, which is from 2005 to 2021, there were various or a couple of tough periods, right? So first, there is the great financial crisis back in 2008 and 2009. Then there is a sell-off in the late 2015 to the early 2016, another market correction. Then in the fourth quarter of 2018, right, stock markets experienced a sharp pullback because of the US-China trade tensions, as well as a more hawkish US Federal Reserve. And then finally, in the last one, we have the COVID-19 pandemic market crash, which happened just last year over a very short period of 2 months. Well, in fact, the fastest bear market you ever see. Okay, and throughout all these periods, right, the multi-strategy portfolio actually performed relatively well. So if you zoom into each of this period and see, right, so in the great financial crisis in 2008-2009, the multi-strategy actually emerges flat. Okay, while the stock market actually lost quite a huge amount of money. Then in 2015 to 2016 sell-off, we're actually slightly up. And in the 2018 last quarter sell-off, we lost slightly, but overall we still do better than the stock markets. And finally, in 2020, during the COVID-19 pandemic sell-off, the multi-strategy actually made quite a fair bit of money. And one of the large contributions comes from our volatility trading strategy, which went long on volatility when the crash hits. So we managed to capitalize and benefit from an increase in the surge in volatility. Okay, so the thing is, when you know how to construct a portfolio properly, you can actually potentially build a very robust portfolio that can help you weather through different types of market regimes better than, say, a pure, simple, traditional one that just simply buy and hold stocks. All right, so that will help you greatly reduce your overall investment risk as well as your outcome uncertainty. Okay, all right. With that, I come to the end of like what I wanted to share on this topic. I hope you learned something about risk today and why it is important. All right, and for your information, this multi-strategy portfolio that I just shown earlier can actually be implemented with the help of our iFAST global advisors, Dawi and Bernard, and we'll be sharing more on it in the upcoming webinars as well. But if you want like more in-depth discussion, like a one-to-one and know more about details, you can also reach out to us now, right? By scanning this QR code here and filling up the contact forms. And after that, we will be in touch with you for a better discussion. Okay, all right, now I believe it is now time for the quiz. It is a very simple quiz. I think just two multiple choice questions. Anyway, it's open book, or should I say like open web. Okay, you should be able to do it in just like less than 2 minutes. Okay, so at this point, I'm going to hand over to Wei, and I'll see you all later at the Q&A session. Okay, Wei, thank you. Over to you.
Thanks for your sharing, Ingguan. Thanks for going through with us risk and return. I'm sure a lot of us have managed to benefit and learn a lot from what you just went through. Okay, so now it's time for our very short quiz. Okay, let me just share. Okay, so the quiz is going to have just 2 MCQ questions. Don't worry, they are very, very simple. And you have exactly 1 minute or 60 seconds to answer questions. Okay, so now maybe everyone can just go to, maybe take out your mobile phones, right? And you can go to ahaslides.com/J8Y6X. Okay, let's give it some time for everyone to enter. I see all the likes coming in. Thank you for all your enthusiasm and support. Okay, once our number of participants stabilizes a little more, then we can begin. Okay, let's have maybe just another 10 seconds more. Okay, let's begin, right? Okay, so please look at your phones. For the lucky draw, we do need you guys to provide some of your little details. So on the field where you see write your idea, please provide the last 4 characters of your NRIC or your passport number if you are not from Singapore. This is for us to also register you the chance at the lucky draw. Let's give this a minute. Okay, we're going to continue in 10 seconds. Okay, so here comes the first question. Okay. Question 1. Which of the following is a risk measure? Take your phones. So we talked about risk a lot just now through Ingwan's sharing. It's a very simple question. Alpha, for those of us who are not familiar with what alpha is actually outperformance over the market. Right, so is that a risk measure? Maybe. Sharpe ratio is a risk to return ratio. Okay, 2 seconds. Okay, thumbs up. All right. Yeah, so the correct answer is volatility. Volatility is our risk measure. Okay, so second question. So what does volatility measure? So we were saying that there are 2 ways in which we look at risk. I do see 2 ways to look at risk over here. What is volatility? Okay, time's up. So yes, the correct answer is uncertainty in your return. Okay, so that's all. We'll be collating your quiz results, your answers, and the winners. We'll be announcing them at the end of the festival. Okay. Thank you for your participation. And now let's proceed on to Q&A. So I do see a number of questions. So maybe let's start with the first. If anyone has more questions, please feel free to just type them in the Q&A chat box. So the first question that we have is there a difference between robo-advisors and quant investing?
Hey, Dawei, maybe I can come in to answer this part over here.
Yes, sure.
Yeah, okay. Actually, in these few years, I think many of us have seen marketing information regarding robo-advisory. Okay, but I want to clarify this part. Actually, robo-advisory is a system of investing, and maybe has been overplayed a little bit too much. Because robo-advisory is just talking about putting in some financial technology or rather some technology into investments. Of course, we started, to put it even more accurately, we started this style of investment, handling investments almost 21 years back when we started putting iFAST as a technology support partner into using unit trust. So this is really not new at all. So robo-advisory is a system of doing things, basically having technology involved in the buy-sell process and reducing the man in the loop, or even 100% replacing the whole man in the loop with technology and computer and systems. So quantitative investing is a little different. I think we mentioned just now it is a style of investing. Yeah, so I give some example. There are quite a few robo-advisories which are still using a long style. That means probably only buying a few unit trusts and putting it into a portfolio, and that is about it, and systemizing the whole purchasing process. And that's what we see in a lot of robo-advisory. Are there robo-advisory methodology that use quant investing? I would think very few. There might be at least probably only one or two portfolio. I'm not going to raise and quote names over here, but I really see very few to even non-existing. There are some very slight elements of it, but are really very few. So just to cleanly see this, one is a system, the other one is a style. So both are a little bit different. Okay. Yeah, that's my input. I don't know whether Patrick has any inputs on this.
Basically what Bernard said is cover both the bulk of it. So basically just want to add that for robo-advisory to work, right, obviously because they're going to service a multitude of individual clients. So to do that, they probably need a systematized approach to implement the portfolio for the clients. So in that, as you can classify it as somewhat like quant investing in the sense that it's systematic investing, but it's not basically in terms of all the strategies that Ingwan has shared earlier. What they do is mainly just doing asset allocation. So for example, for more so-called for clients with riskier profile, right, they'll probably allocate more towards equities. And then for clients with maybe lower risk profile, then they will allocate more towards safer asset classes like bonds. And then they will do regular rebalancing as the investment process goes on. So yeah, but quant investing, we are really referring more to a more specific style of investment, like what Bernard mentioned. So it really, I would say it's a very broad universe out there. There are many types of quantitative investing approaches. I think what Ingwan has shared with you guys is just a tip of the iceberg. There are literally hundreds and hundreds of different styles of quantitative investing out there. All right? Yeah, that's all.
Yes, okay, so thanks for answering. Let's move on to the next question. Okay, so the next question is, what is the minimum amount to invest in this strategy? I believe this is referring to quant investing strategies, right? And what is the kind of performance this strategy has? Maximum drawdown and expected returns for the next 2 to 3 years. Maybe Ingwan, you want to come in and share on this?
Yeah, sure. Okay. So if you look at the multi-strategy portfolio that I shared earlier on, right? So that one requires an investment across 4 different strategies and is globally diversified, and it has more securities that you need to go in. So in terms of the minimum amount, there is a recommended. Okay. So we were looking more at 100,000, right, in order to implement that, but it can actually be structured or designed to be lower. And in fact, we have another portfolio which is meant for like smaller investments that was available, but I did not publish it, or I did not kind of presented it in the slides earlier. So that one, the performance is also comparable to the multi-strategy portfolio, but it is US centric and focused across less strategies, right? And it has less securities. So in terms of transaction costs and cost effectiveness, well, that is much better suited for smaller types of investments. Okay, and then for the question of the performance, okay, so if I share my screen again, yeah.
Sure.
So let me get back to just now the slides earlier, right? Okay. So this is a slide I shared earlier, right, which actually gives you the breakdown or the broad breakdown in terms of the performances. So the annual expected returns that roughly you can get out from the multi-strategy portfolio, right? The model is about 11, right? About 11, and that's net of fees. So net of fees or whatever is being charged, right? And in terms of all this 8.8%, and the maximum drawdown it has experienced so far is about kind of like 12%. And is it going to do like this over the next 2 to 3 years? It is, going to be hard to tell, okay, at the end of the day. So the portfolio can go up and go down. It really depends also a lot on the market conditions that come in. So what we can say only is that it is a fairly stable portfolio, and over the long run, like what we've shown here, right, like 10 years, 15 years, the rough return that you can expect to get is roughly around the range that is shown here. So probably in the range, maybe 11, 12%. Yeah. Okay, anyone want to add anything, Patrick?
I guess maybe just to, okay, the thing is, a lot of people probably like to ask questions like, what is the expected return of a strategy for the coming years ahead? But that's precisely the kind of mindset that I guess how professionals would like to turn around, because rather than asking questions like, what do you expect this strategy to deliver in terms of returns for the upcoming years ahead, right? It's more fruitful to ask questions like, what can I expect to, or rather I should say, how can I expect to protect my portfolio if, let's say, a certain event were to happen in the coming next year or so? So I think that is a more fruitful approach, question to ask, because that question, right, you can do something about it, because then you can go back and look at your portfolio and see, oh, perhaps I have a bit more exposure in this area that will not do so well if this event were to happen next. So then I can do something to either lower the exposure or to have other exposure that can cover up for damage in that particular aspect of the portfolio. Because returns really is something that market delivers. It's not something that you can position your portfolio for, but it's something that, what happens in the market will translate into what you see in terms of returns for your portfolio. But that is, I would say, it's unpredictable. Nobody can predict what's going to happen in the next year or so. But what you can really do, right, is to really look at your portfolio, your existing portfolio, and see whether is there any area of weakness that you can actually overcome and compensate for. Yeah.
Thanks, Ingwan and Patrick. Right. Let me just come in to just add on as well, because our question did ask what is the minimum amount to invest in a quant strategy. Right. Realistically, what we have seen is that definitely a strategy that has in the area of maybe 6 digits or 100,000 USD, you can have a lot of elements inside your quant strategy and definitely a lot of diversification done. Okay, but that being said, right, we have also seen portfolios run in a quantitative manner with just 10,000 USD, and that's actually one of the portfolios that AllQuant, I believe you guys have already been running already, at least to my knowledge. Okay, so hope that also answers that part of the question. Okay, so let's move on to the next question. There is a question on whether the last chart shown is based on AllQuant investment returns. I think that was the chart that we just showed. Right. So, Ingwan, Patrick, maybe you want to just quickly answer this? Sorry, Ingwan, you are muted.
So is the last chart shown based on AllQuant investment returns? So again, the last chart is shown is what we call model performance. So I think part of it is actually closely matches in terms of what we run personally within AllQuant itself. But of course, we haven't started AllQuant 15 years ago. So the earlier part, a lot of it is based on model returns, that is using historical data and then putting it inside the model to generate and see what the actual performance is going to look like. So I think backtesting, this entire process is what we call backtesting, and it is a cornerstone of all quantitative hedge funds. And we use that a lot in terms of like designing, coming up with strategies that we can invest and implement and deploy live out into actual live investing. Yeah.
Thanks, Ingwan.
Yes.
Right, next question that we have, what is one type of quant investing that we can apply personally for our own investments?
Okay, maybe I'll start with that. There's actually a lot of quant investing strategies that are actually available to you if you know how to do it. Now, of course, you can't implement like high frequency trading or those statistical arbitrage strategies, because you won't have a competitive edge in those. Those are implemented by larger funds, like your hedge funds, who have the means and resources to actually compete in that area. But things like asset allocation, these are even simple things like asset allocation. If you know how to do it and you do it right, you can actually build a portfolio that's very robust, right? In terms of being able to kind of weather different types of market regimes. So in one of the upcoming webinars, I think in the following week, I think I'll be talking about an all-weather asset allocation strategy, which is one of the quantitative strategies that's being used, right, for asset allocation purposes. And that during the session, I'm going to share with you also how or what is the difference, right, between this asset allocation versus your traditional, like your 60-40, 50-50 kind of strategies. So that strategy is actually based on risk, again, like related to what I've talked about today. And it's actually dynamic in terms of its allocation because it adapts, right, to your changing market conditions. Okay, I'll share more about that, right, later on.
Thanks, Ingguan. Let me just come and answer one of the next questions as well. I do see this question over here. When investing can sometimes be known to be risky for older individuals in their 60s. Right? So for those in their 60s, if we are considering to do quant investing, how should we implement and guard against the risk? Okay, so a few things to take note over here. Right, so just now, Ingguan has mentioned very well that a lot of times actually quant investing, we are focusing on lowering that risk. Right, so there is a general notion out there that hedge funds or quant investing, they are very risky, but it actually tends not to be as true as what the media makes it out to be. Okay, so actually a lot of times, right, when we run a very well-structured, well-diversified quant investing approach, it can actually lower that overall risk for our portfolio. Right, so especially for the example of, let's say, an older individual who is in her 60s, right, I believe, right, that definitely someone at that age group, we definitely don't want to be utilizing retirement funds for any equity-based investing, right? Or we can, but that portion actually tends not to be so much necessary for retirement. Okay, so the remaining portion of funds that can actually just be left to go that are not needed for individuals' retirement, right? These are funds that we can implement, say, any proportion that you're comfortable with, right? So there are those who are okay to run 50, 60%, right, quant investing, right? The remaining traditional investments, fundamental investing, right? And so this is one way in which we can come in and run this quant investing for those who are a little bit older. Okay. So we do have a number of other questions, right? And we are running out of time. So maybe let's just have one last question. Okay. So besides volatility and risk, what kind of quantitative research is built into this portfolio strategy? Patrick, Ingguan, you guys want to come in and answer this?
Okay, your question is actually quite broad. Huh? Like what kind of quantitative research is actually built into this portfolio? Of course, we are showing you the final end result in terms of just a few key like performance metrics that are more easily kind of like understood by most people out there. But within the actual like research as well as the testing or building of the models itself, actually it's a very intense and rigorous process itself, right? It actually starts from like collecting the data, making sure we have reliable data to kind of process or even build the model itself. Then after that, within the testing phase, you're going to start out with your initial concept. So first of all, your concept must be kind of like sound and it must make sense for you to be like fundamentally convinced that this is something that you want to test out. This approach that could be something you want to see whether it works or not. Then after that, you move on to the process where you actually build the logic of the entire models, and you're going to test every single part of your logic to make sure that you are doing it right? And after that, you get the performance of the data. Then you're going to ask a lot of questions like, no, is this performance what you expect? And you're going to break it down into different parts, like different periods of how it actually performs. You're going to narrow and zoom in, like what are the strengths and the weaknesses of this model? Is it in line with your kind of expectations? And when it performs well, how well does it do? When it performs badly, how much can you expect to lose? So a lot of questions that are involved and analyzed during the entire kind of modeling and build the process when you actually build up the models. So it's, of course, at the end of the result, this is what you see and get, which gives you the chart as well as the performance metrics. But yeah, there are a lot of individual analysis and smaller subparts that goes into the entire process itself, which will be too much, right, to really talk in just a single Q&A session. It'll be an entire topic by itself, actually. Yeah. So anyone want to chip in or anything? Yeah.
Maybe just want to answer one more question that came in. I guess this person is trying to ask whether is any real capital being run using this multi-strategy approach. So I think that's a very good question, because at the end of the day, what works on paper may not actually work in real life, right? So the fact is that we already have clients on board who are actually running this multi-strategy approach through iFAST. So Dawei, correct me if I'm wrong, but I think the performance so far that the clients are seeing are pretty much in line with the model results. Am I right, Dawei?
Yes, Patrick. So we do track the difference in performance, if any, between the model itself based on what we have, right? And also what actually happens, right? So what actually happens, definitely we have to take into account certain processing criteria, right? But actually the model performance that we are looking at is already discounted based on a lot of other processing and even fees involved as well. Okay, so yes, I do see a very small, if not even negligible difference. Right? So it tends to be around the difference of maybe 0.1% for that month itself. So yes, yeah.
And the difference can be either good or bad, right? So over time, it should even out.
Yes, we do that rebalancing to really keep in line what we have in the model, and on top of what we are running live itself. Yeah. Okay, so we do have quite a number of questions remaining. Okay, but no worries, right? We will try to answer them, right, either through emails or through some of our further webinars down ahead. Okay, so that's all for today, right? Thank you very much for your time, right? And we just want to bring up that festival calendar. Let me just yeah, hold on. Yeah, so today we have our first session on the 11th, right? For those of you who have signed up for the next session on the 14th, right, we're excited to have you next coming Tuesday. Okay, it's going to be at 7 p.m. It's on a weekday. That's why we are intentionally having it after your working hours. Right? So if you did sign up, right, remember to join us. Right? We are looking forward to see you there very soon.
Okay, and just to add on or reinforce what I've said earlier, so if you still have a lot of like burning questions or queries, regarding the models portfolio, as well as how they can be implemented with iFAST Global Markets, so you can scan the QR code, which is on the you can see on the right hand side over there, and then I think Dao will be in touch with you very shortly, and we can have a good session to discuss through and talk about it, what the model is like and whether it is a possible fit for you to actually use it. Okay. Yeah. Thank you everyone for coming.
That's all for today. Thank you, and I will see a very large number of you guys very soon. Okay, so that's all for this afternoon. Take care and enjoy the rest of your weekend. Bye-bye.
Thank you. See you. Bye-bye.
Bye-bye.